Hello, everyone. I'm Steve Carver, and we'll get started now into our first of a 5-part series, a 10-hour course, focusing on enhancing business skills and strategies. You're always welcome to contact me anytime. We've got a lot of flexibility in this program, and that if you want some questions answered or for me to spend some time on a particular aspect of your small business in any way or concerns you have, just drop me an email, let me know what it is, and I'll try to include it in the next session. We've got a lot of flexibility. I'm not a lawyer, I'm not an accountant, I'm just here offering you free advice as someone that's been in business for 63 years. Today we kicked off the sales campaign in my business, and we named it our 63rd annual year-end sales. So 63 years in business. I've made a lot of mistakes, still surviving, so we'll call that maybe just a touch of wisdom, and I'm glad to share it with you. Always get a second opinion on an important question that you're having, and the Small Business Centers is a good place to get it, so just remember that. So our program starting now through for 5 weeks. We'll have 2 different sections in each night. You can log on at 6 o'clock, and we're glad to have you, or you can log on at any time up till 8 o'clock and join us. If you're coming in late or you're having trouble getting right on at 6, please come on anyway. We're glad to have you. Even if you come in late, it'll be just fine. So looking forward to getting this started. And if you attend 4 of the 5 sessions, you'll be eligible to get an achievement certificate, which one of our entrepreneur members, associates, is designing for us as we speak, actually. Next week, we're going to be talking about 20 different businesses that you can start with $100 or less. This has been a real popular lesson that we've given through the last couple of years. Gives you some good ideas, maybe not only on the business that you're starting, but maybe some profit centers that you would like to start as well. That'll be the first part of the session, and then we're going to be talking about creating more and more raving fan customers by using techniques that we'll talk about of customer service with a capital S. I think you'll really enjoy that. It gives you a good basis of customer service understanding, and we're happy to share that. That'll be next week, next Tuesday night. One of your handouts is the 40 Street Smart Drill Skills. If you register with the Small Business Center, they have already sent you your handouts. If you don't have them, if you came in late and did not get your handouts for these sessions, just put it in the email, in the chat board there, that you'd like for me to send you copies of the handouts, and I'll be glad to do that. I'll email them directly to you, and I'm glad to do that, plus any other study guides that I mentioned or that you might want. I'm glad to send those to you as well. Everything's free, no charge for anything. One of the handouts is the 40 drill skills that we work on in all of our continuing sessions to help you get more confidence, learn a lot of skills. So if you'll take that handout, look at the videos and practice them, you'll find you'll get a lot of benefit from them. Moving into our discussion now about depreciation. A lot of folks have heard of depreciation all your life and know that it means maybe losing value. That's true. But when you're entering entrepreneurship, it takes on a whole more important meaning and definition on how depreciation can affect your business. As you're buying and selling products and accumulating wealth or creating assets or building a book value for your business, the word depreciation comes in all the time. When you're paying your taxes and you're thinking about what you might have for deductions so that you can reduce your taxable income, depreciation becomes a major player. When you're borrowing money and you show the banker or the lender your financial statement, it may show that you're not making any money whatsoever, and therefore they may not want to loan you any money. However, if you have played your cards right and you've listed your depreciable items as assets, assets are the same as money as the lender looks at it. So it becomes really important that you manage your capital assets, and all of those are depreciated. So all that is a part of what we're going to talk about tonight. Now, I've been in business for 63 years and have used the word depreciation a million times, I'm sure, but knowing the ins and outs of it in an accounting system, or how it plays in and out of my federal tax returns in the right down in the trenches, I don't know that. I think that's what accountants are for. But I do know that it is ultimately important that all of us as entrepreneurs understand the basics of it, so that we can apply this when we're doing tax avoidance decisions that can make a difference in whether you're able to stay in business or not. So we'll talk about that. I searched the internet last year for someone that had written a few short pages better defining depreciation than we'll have time to do in the 1 hour tonight. And I found this great article that was written by Lisa Borga that goes into the details a lot more than we can do it in a webinar to give you some backup support. So I suggest that you print out that this handout that I've sent to you, Understanding Depreciation. And when you have time, drinking a cup of coffee one morning or on a Saturday or a Sunday afternoon, you have a chance to take some reading time. This is a good thing worth reading, trying to let some of it soak in and to also save it in your business journal. So glad to share that, and we certainly appreciate Lisa sharing it with us. So let's kind of get into it now. What is depreciation? Let's define it. First of all, depreciation is defined in a business sense as a reduction of value of an asset with the passage of time due to wear and tear, and of course time. Everything depreciates that sits out in the weather or that's used, right? Well, it certainly does. So these assets like machinery or tools, they're expensive and they cost a lot of money. And when we look at the entire cost of what they are, by using depreciation in business, the laws allow us to use depreciation in business so that we don't have to pay taxes on the profits that we use to buy new equipment and assets. We don't have to pay for it all at one time. It kind of gives you an incentive to invest in your business. Federal government does this to help manufacturers. The federal government does this to help new businesses like yours and mine get started by offering certain incentives and extra depreciation write-off options for the items that you're going to think about starting your business with. From that standpoint, it's a really good thing. As a matter of fact, I don't know any bad thing to say about depreciation other than the fact that lots of entrepreneurs just don't understand how to use it. So that's why we're having this discussion tonight, to help you do that. Let's have a little example here about depreciation. Let's say that your company is just getting started and you have $10,000 in the bank. I mean, that's cash money right in the bank. So you already know that your business today is worth 10 grand. I mean, it's there, it's cash, 10 grand net worth, easy. Good place to start. However, money does a business no good sitting in the bank, so you need to buy an industrial saw. Let's say that you're in the cabinet making business, and you need to buy some equipment. Let's say that you're in the internet hosting business, like Madison is. He's going to need to buy some servers and some pretty expensive stuff. Let's say you're thinking about starting a sales lot, selling cars or forklifts or things like that, like Darlene's thinking about doing. You don't have to buy some stuff, and it's going to be important that when you take that money out of the bank, that you know something. So when we purchase that $5,000 industrial saw, we have reduced our cash by 5 grand. But the question now is, for us to get an understanding of depreciation, we've used that $5,000, but did our company go down in value by $5,000 or 50% because we bought that saw? And the answer is no, absolutely not. It did not, because that saw is still there. It is still new today. So you still got $5,000 in the bank, and you got $5,000 brand new saw, and it hadn't depreciated at all because it's brand new. So on this given day, your company is still worth $10,000. Still worth 10 grand. But the rest of the story is tomorrow and the next day and next year and so forth, your company is going to go down in value, or the value of it's going to go down as that saw gets older and more used and has less value. So we need to track how that depreciation goes down, and we do that through the depreciation parts of our reporting form and our financial statements. Because that saw was a tangible asset, because you could touch it, it was tangible, and it's going to last longer than a few days or a year, it becomes what we call a capitalized asset. So think about this now. Assets are capital items. We use the word capital as, first of all, we talk about cash, sometimes it's referred to as capital, but not here. We're not doing that here. Capital items are those items that are assets that are real, that we are depreciating, and that we have them entered into our depreciation list of our business. The depreciation sheet of our business in the financial section is our list of assets and on the financial side, okay? So the saw, when it's brand new, still worth $5,000, so your company's net worth was still $10,000. But as the years go by, we're going to depreciate that saw. And the laws give you the option. The Congress from time to time changes these, so I'm going to put this in here. They're never the same. You always have to be double checking. There's always going to be a need for an accountant to help you with this. But the book values will change, but by the same rate that you're able to depreciate or write off. So we don't use that term now. You've heard the term write off before. That has everything to do with depreciation. That has everything to do with you write off by using depreciation, okay? So let's say that we've got a 5-year write-off plan that we can use on assets that we're buying this year. So we enter that item, that saw, by serial number and the date it was purchased and the amount we purchased it for. We enter that $5,000 on a depreciation sheet at a $5,000 value. And we're going to take a 5-year write-off, which means every year we're going to decrease the value of that saw by $1,000. Just as we're doing on the slide here. Second year it goes to $4,000. Third year it goes to $3,000. The last year it's worth $1,000. And at the end of the 5th year, 0. These is just numbers that are written on your depreciation sheet. It's values that are listed on your depreciation sheet. So the first year you had the saw, it increased your assets by $5,000 book value. And at the 6th year, it shows on your books worth 0. Here we start using the term book value of a business. The book value of a business is the total sum of its asset as recorded on the depreciation sheet. As recorded on the depreciation sheet. Nothing to do with fair market value or retail value. This is strictly book value, how your accounting records value the equipment. Now, the good part about depreciation is as we were decreasing the value of that saw over a 5-year period, each year we took a $1,000 write-off based on that saw coming down in value. So when you bought that saw, it started making you money. You started using it, making things. But also because you bought it as an asset and put it into your depreciating code, that saw starts making you money another way in that it decreases your tax exposure. Yeah, $1,000 a year. Now, there have been some years when the law would let you just write 100% of your purchase off the first year. But that has some pluses and negatives to it that we'll talk about a little bit later. But we're dealing now with the usual standard 5-year write-off or 3-year write-off or 7-year write-off, different time periods for different items. Your accountant will be able to tell you about those. Now, let's say that we depreciated the item, and after 3 years now, we're pretending we're 3 years down the road, it's still on your books at a $3,000 value, right? That's what we agreed that it would do. So let's say that you want to sell that saw. You want to take it off the books and sell it, and you want to show a $3,000 loss of the assets and have no more tax exposure on it. Well, let's say it was stolen, so it's just gone. And it's just gone. So if you take it off your books, that means you're going to lower your assets by $3,000. You're going to lower your book value. Plus, you're not going to be able to get that $1,000 a year tax advantage. So sometimes you'll think about this in tax avoidance. You'll think about this. Well, I think I'll just leave that on my books. It's not here, and I can't put my finger on it. But if I take it off, it's going to hurt the value of my business. Well, that's a decision that you may or may not be able to make, and you should talk to your accountant about it. But oftentimes, as you start accumulating lots of stuff, they get missing. Like you trade computers in, or you sell a used car, or someone wreck something and it becomes of no value. So this depreciation list always has a little bit of conversation to go along with it. It always does. So you got a lot of options that you can use. But after 5 years, let's just say that you still got the saw on hand, and you've written it off, and on your book value, it's going to show 0. But the old saw's still there, and it's still running, and it still has a $3,500 real value or fair market value. You see, fair market value doesn't have a thing to do with the book value of your business, so therefore you have to think about that. Now, you go sell that saw for $4,500. And when you did that, you sold something that was on the books at 0 for $4,500, and you have just increased your tax exposure by $4,500. But if you sell it for $100, you increase your tax exposure for $100. So what would someone maybe want to do? They want to sell that saw and get some cash out of it, but they don't want to have to pay taxes on $4,500. Well, you don't think about that, and probably you don't figure out a way to sell it to someone for $100 and then let them sell it for $4,500 and y'all share in the profit, or something like that. Some type of scheme, so to speak. That is treading on the edge of tax avoidance. And if you keep it legal, fine, but if you go over to the other side, that would be tax evasion, and you might get in trouble. So it's important that you understand how these are affecting you when you take things on and off of your depreciation list. Sometimes it's really good to know that that saw stays on your books at 0, but you know it's worth $4,500 and it's still making you money. It's good to keep that old saw around. So if you get in a tight one day and you need to convert it to cash, you're able to do that. You'll figure out a way to make it happen, and with the least amount of pain. After 5 years, you still have it on the books for a 0, and the fair market value is $10. Take it off the books. As long as if it actually loses its value, totally fair market value, you've used it up, it's junk, then I suggest you take it off the books, forget about it, and stop worrying about keeping records on it, paying insurance on it, having to explain where it is not. Sometimes you just need to clean your depreciation list up and move on with it. So now let's look at the overall picture on what a lot of depreciation items might be doing for you. let's say that you are having a pretty good year and your taxable income exposure is $80,000. You've made made a lot of money, and you've got $80,000 estimated tax exposure. Now that's not how much tax you got to pay, but what your tax percentage is going to apply to. And you purchase a brand new asset, let's say a used pickup truck or a piece of equipment, or some office equipment, or medical beds or supplies, printers, other things that you might be purchasing. Nicole, Patrice, you might be purchasing a brand new or a used van to carry people back and forth to the airport, going on the cruises. So there's a lot of reasons that you might have a $45,000 purchase. And if you were in a year when you were able to take 100% write-off, and you purchased something worth that $45,000, you would reduce your taxable exposure by $45,000, and therefore the tax your taxes would go down more than half. If you were in a 3-year write-off plan, you could reduce your taxable exposure by $15,000. A 5-year write-off plan, reduce it down to $9,000, and a 7-year could reduce it by $6,000. So you can see that if you're making money and having to pay a lot of taxes, purchasing new assets can be a way to, instead of sending your tax money off in big numbers, is to use that money to make a down payment and buy something and add to your assets. Oftentimes, established businesses dealing in bigger numbers and investments will indeed purchase items to avoid tax exposure. In other words, they're making money with the use of depreciation. Now, I'll say this one time and maybe many more before the night's over. Before you make an important decision based on, I'm going to save money by buying something because of depreciation, you talk to your CPA. You don't talk to Papa Steve-O here. You talk to your CPA who knows your books and your situation, and they will be accountable to give you really good advice as it applies to your business. But this is a big deal for folks in businesses that's going to buy a lot of stuff for assets or buy a lot of stuff to be selling it. Just remember this, very, very important. The term is called, you got to spend money to make money, and I believe in that. I know that that's true in advertising and investing and being able to take advantage of some hot deals. But purchasing assets to avoid paying taxes, that's a dangerous and slippery slope. So again, get good advice when you're doing that. Now let's say that you're having a great year and you think that you're going to owe taxes on $80,000 again. And your tax rate is 23%. You're paying a 23% tax rate. That's kind of about the middle of the board for most startup entrepreneurs. Could be more, could be less. And you purchase an asset that's worth $45,000. Same scenario as before. If that was the case, you at $80,000 are going to pay $18,400. But if you purchase that $4,500 new asset, see how your tax payment can go down or up. If you got a 100% write-off, instead of paying $18,400, you would only pay $8,100. So purchasing that asset, that $4,500 vehicle, saved you $10,000 cash payment in taxes. Pretty darn significant, right? And even on a 3-year write-off would save you $15,000. Excuse me, would save you $3,000, and so forth. So depreciation can really work for you in a positive way. And it is an incentive to help businesses buy new assets, helping the economy, helping keep their material up, helping them raise their book value and, of course, fair market value. But a slippery slope if you're buying these items simply to save tax money. The bookkeeper's not going to know about this. And the guy down at the restaurant who pretends to know all about everything, he's not going to know about it. But your CPA is trained to know about it and to give you the right advice. Now, I've always been one that says that CPAs can't run your business for you. They don't know how to sell. They're bean counters. And oftentimes the CPA advice may or may not be really good in helping you make good sales decisions, business trend decisions, marketing decisions. But on this one, they're the person to call. So what are we talking about now? Let's talk about what are those large tangible purchases that will apply, that depreciation will apply to. It's things like real estate, furniture, fixtures, manufactured machinery, computers, phones, vehicles and trailers, leasehold improvements. Yeah, even if you are renting or leasing a piece of property for your business, and rent and lease payments are not deductible, they're not assets, but the improvements that you make on your rental property, those are called leasehold improvements, and you can get some help on those with depreciation. That's to say that you're renting or leasing a piece of property and you want to put some new offices in it or some new restrooms or buy a new sign or air conditioning system needs to be replaced. Maybe you want to put a drop ceiling in it. All these are major expenses that will come out of your, you'll pay for with your tax dollars, with your profit dollars. And the government is saying to you that if you're improving your property that you're renting and you're going to stay there for a long time, these improvements you get help with it. So depreciation encourages you to uplift your property, give facelifts, make it improvement. Whatever it takes to improve your business, sometimes depreciation is the way to help you get there. Very important factor. But there's some items that depreciation does not apply to where it will never help you. And that is in your website expenses, any of the disposable items that have short life. It won't help you with property that you're renting or leasing, the actual payment of those rental payments. Service contracts, nope, doesn't have a thing to do with that, or just your regular monthly bills. They are not tangible items, and therefore they will never be affected with depreciation. So remember, say it to yourself now, depreciation is all about a reduction in the value of an asset with the passage of time or to how much wear and tear it has on it. When does it start? When does depreciation start? On your books. It starts the day that you purchased a unit. So you always keep in mind, Tyler and Linda, if you're buying something that you are pretty sure is going to be a depreciable item, a capital item, when you buy it, make a note that you can find later on. Write down the model number and the serial number, the date you purchased it, who you purchased it from, and the amount. Yeah, you'll have all that in your checkbook, but it's a good idea to have it over on another little sheet of paper that will be used to start your first depreciation sheet. So keep a record of these items that you're buying and when and how much they were, and by serial number so that you can insure them as well. So you purchased it, and then over a period of time, just like on the scales, the value will decrease as it gets older or more used. When does it end? When does depreciation end? If this was a test question, it ends when the asset has a paid for itself or has become worn out and it's reduced all the way down. It's reduced all the way down to having nothing but a salvage value left, just a salvage value. And we're talking about on your books. So let's talk about a few points to remember related to depreciation. First of all, it allows you to move assets, the asset cost, from one balance sheet to the income sheet. See, when you buy it, you're showing it as an investment or as red ink, but because of depreciation, it allows you to put it back in over on your depreciation sheet as an asset, and as you're doing your taxes, it helps make you some money by reducing your income tax exposure. It allows you to buy items for the entire amount, but pay taxes on a smaller amount because you're going to pay taxes on that write-off period. 5-year write-off, you pay taxes on the $1,000 if it was a $5,000 item instead of on the full $5,000. It ties your cost of doing business by buying those assets with the benefits that you gain during its useful life. So it encourages you to purchase an asset thinking and justifying, remember, always be connecting the dots, justifying that this is going to be a good investment because it's going to make me X amount of money. I'm going to have my net worth is going to go up, plus I'm going to get a little bit of kickback incentive with an extra amount of depreciation tax reduction. Now, definitions here, points to remember. And you will hear this from time to time from your accountant. The accumulated depreciation. On your tax return, when it shows the amount of income that is taxable, right under that it will be less accumulated depreciation. And that number will come from all the way back in your tax return on your depreciation sheet, where all the depreciable items have been listed up and what each one of them, the truck, the saw, the improvements that you've made, the new computers, the depreciations on every item that you've purchased that are still on your depreciation sheet, even though some of them may be 3 years old, 4 years old, brand new. All those items you'll have an amount of depreciation they've earned that'll total up, and that is your accumulated depreciation, which will come off your total taxable income exposure. Kind of an important number to know what it is and where it comes from. The reason why, let's say your lender is looking at your financial statement and you haven't shown you've made any money. Maybe even you've lost a little bit of money. But when they look down on your tax return and see that you had $60,000 depreciation, then they're going to take a different look at you, a different light of you, because they're going to say, well, you made enough money to pay that $60-some thousand worth of depreciation that you're taking off, and therefore maybe you're going to be all right because you got things under control. This will play different. There's a lot of wiggle room in there that you can consider it, but I've seen for so many years that someone was able to borrow money simply because of how much depreciation that they had earned during a given year. Now, the high rollers, the billionaires that you hear about all the time, they play this to the hilt because it's all about depreciation with them. How much loss you took on an asset, how much was it really worth, what was the fair market value. Folks who deal in the big numbers, the millions and the billions, man, they play this thing like a fiddle, no doubt. When you're carrying an asset, what you're going to be doing is you're going to carry that asset less, what that is the purchase value less how much you've written it off, and that's the carrying asset value of an item. That $5,000 saw, when you first got it, you were carrying it at $5,000 value. 3 years later, you're carrying it at $2,000 value. So the carrying value of assets will be determined by how fast you're writing items off. When you have carried the value all the way down to pretty much zero, that's called the salvage value of an item. What it would sell for at the junkyard. and that might be zero, or it might be $100 or whatever. So sometimes businesses will take a value, and you can write it down further, if providing you're not lowering your tax value on it. So let's say you used all the tax value that you could last year, but it's still on your books. It's still on your books for $5,000, but excuse me, for zero, but you know that it's worth $5,000. So you may do a reduction of assets, a capital asset, and manually just reduce that value down, take it off the books. Excuse me, I'm getting tongue-tied here. Take it off of the books and sell it for a low value off the books, and then take it under control of yourself, or pass it on to someone that you want to give a gift to. If it's not making you money at your company, and it is not bringing you any tax advantages on your depreciation sheet, I suggest that you liquidate it and either take that money and put it to work for you somewhere else. So let's talk about book value now. Book value is what the accountant looks at your financial statement, the total amount of your assets less the amount of depreciation comes back down to the book value of a business. The book value also is the total of your depreciable items on your depreciation sheet. It's important that you never ever confuse book value and fair market value as the same thing, because they are not. The book value of a company may be $200. The fair market value of it may be $2 million, or any other numbers that you want to put on the sheet as far as a possibility, because book values are always coming down. That's right. That's the depreciation. Depreciation never pushes something up. But you know as well as I know that sometimes things appreciate, in other words, become worth more. And that depends on what you're selling and what you've bought and such as that. So the fair market value needs to stand aside as what is the real value that you could sell it for in the marketplace today. And the book value you always need to keep in mind is simply what the numbers indicate the assets are still worth after being depreciated. That's the book value versus fair market value. Okay, depreciation, who really cares? I mean, y'all been so kind to sit here now for an hour and let's talk about depreciation, but who really cares about it? Well, there's 5 groups of people, 5 different entities that care, and I want to tell you why. Because we don't have to be dealing with these folks all the time. First of all, your creditors. Your creditors are going to care about it because they're going to want to see how you've been spending your money and if you've been buying smart. And if you've been buying items that can show up on that depreciation sheet and they can track it and they can see that you're spending money wisely, the creditors will like you more. And that depreciation that's been taken reflects a value of your tangible assets. So the creditors really like to see depreciation. It helps them track what you've been buying. It's a very positive thing in tight times. More depreciation that you've been able to earn, that makes your financial statement look better. Now your CPA really cares. First of all, because they have to keep up with this stuff and they make more money. The more depreciable items you have, the more complicated your tax return will be, hence the more money your CPA is going to make. But we don't have to have them, and that's just a given. But because when it comes to depreciation items, the CPA is going to be a major part of that. The IRS cares because they want to make sure that you truly do have these items and these numbers are correct, because it's reducing the amount of tax that you're sending to the U.S. government. Now, the county tax people really care about your depreciation item because your depreciation sheet is the basis that they use. It's the basis they use for determining how much county taxes you owe. You see, the counties don't charge you taxes based on your income. No. The counties charge you taxes based on your assets. And your assets are listed on the depreciation sheet. Therefore, each year as you're taking these write-offs and your depreciation value goes down, guess what? The amount of tax exposure you have to the counties go down as well. So it's important to them. And you care very much, because it is a definite reflection of the book value and the fair market value of the company. Yes, the book value stands for itself based on the numbers, but you know they're not the same, but you have got to go back at those assets and look at what the fair market value is of each thing that's still on your books versus the book value, so that you can determine what your company is really worth, because that is the number that becomes the collateral number. The fair market value is based on, will be used when they're coming up with a collateral basis. The book value is simply a bookkeeping, it's in the numbers, counting the beans. But the fair market value is determined on how much collateral or borrowing power that you might have. So any questions about depreciation, write them into chat, or you can turn your microphone on now and we'll chat about it. If something comes up later on, you're welcome to send me an email. I also mentioned that the subjects we're talking about, this depreciation and taxes later on, I'll also be discussing those tomorrow night and Thursday night in our 10-part series, which is wrapping up tomorrow night and Thursday night. But if you'd like to hear some more of this, you'd be welcome to do it. In addition to those of you who have not been a part of our series that's been going on Wednesday night and Thursday night, we'll also be talking about some secrets about how to close sales as we wrap up our 10-part series. So you might enjoy joining us on Wednesday and Thursday nights as well. You'll certainly be welcome to do that, and you'll get credit towards certificates for doing that also. So depreciation, here we go. Let's talk now about avoiding tax problems. And the number one problem with startup engine entrepreneurs is getting caught by surprise with a tax bill that you're unprepared to pay. And every accountant that I spoke with, and I probably talked with 12 or more, and asked this question. Listen, I talk to new entrepreneurs all the time, startup folks, and what advice would you have me give to them just getting started, first year in business, about taxes? And every one of them have responded with almost exact word for word, as if it was something they were taught in school. Steve, please help them not to get caught by surprise. So the recommendation from the CPAs is you must learn to pigeonhole tax funds that you're taking in for future tax payments. Your business is up and running and you're charging sales tax, or you have employees that you're going to have to withhold tax payments for their employment, Social Security and unemployment compensation and such as that. So just because you've made payroll and paid the employees doesn't mean that you have finished paying the U.S. government the taxes that you were supposed to have taken out of their checks. So this is a big deal and kind of difficult when you're first getting started, and you might need some good advice from your bookkeeper. That's where a bookkeeper can come in and help you so much. But here's the deal. If you've had a really good month and you've sold a lot of stuff and you've taken in several $1,000s in sales tax, and you don't have to pay that till the end of the month, but you've been paying your bills right along and you thought everything was paid for, you paid off what you had purchased, but then all of a sudden you realize, hey, I've got a $10,000 sales tax payment I got to send in tomorrow. And if it's not in the bank, you're in trouble, because there is no give me a break here. So you don't have to go borrow the money or rob Peter to pay Paul or do something to pay those taxes. And it becomes very, very stressful, because if you don't pay them, here's what you're facing: fines and maybe even going out of business, because the taxes are going to be paid or the folks are going to put you out of business. So just keep that in mind. Find a way to pigeonhole the money as you receive it, that tax money, so that you don't use it for other items. Now, when it comes to taxes, all your taxes are based on keeping your records. And whether it's your monthly items that the bookkeeper's doing for you, your daily and monthly stuff, or the long-term stuff that you pay taxes at the end of the year, or that's subject to audit, record keeping is always a part of your tax considerations. So figure out how you're going to keep your records, either in paper or computers, or using flash drives, but know that they've got to be kept, and it's up to you to do it. Some of the records have to be kept permanently. Just makes sense, of course, and it's up to you to look them over. They're here on in your slide, and I don't need to read them all, but everything from your articles of incorporation to copyright stuff, your stock certificates and deeds and mortgages. Some items you will keep forever. Some of these are paper, so you don't need a place to keep them. A place that's safe, not going to get burned, not going to get flooded, a place that you can get to if you need to in an emergency. Your certified tax returns, trial balances from your accountant, liens and permits, you'll want to save all that. If you've got trademark registrations, you'll save all of that. Now, a lot of items don't have to be kept permanently, but they do need to be kept for 7 years. 7 consecutive years, a certain group of items need to be paid, and they're all listed here for you. You can certainly read them. But the ones I want to highlight for you are ones called the bill of lading, because that is proof that you shipped something from one point to another. And in the tax world today, sometimes when you ship items out of state, you don't have to charge the recipient sales tax. But you do have to prove that it went out of state, and that bill of lading is how that you do that. A lot of items you will have to charge tax on, so that depends on what you're selling and what you're doing, but it's very important to your business. You do want to keep employee personal records after termination, because you just don't know when down the road someone that used to work for you may claim that they were hurt on the job when they were working for you and come back to you for some type of compensation or a claim against you. So you want to save those personnel records that prove that people, when they left you, were not complaining about being hurt. There was nothing in the record that indicated that they have any claim against you. If you got the records, then you got some tools to work with. Sales tax returns, all your invoices, cancel check, 7 years. Now here's where I like to say, strike through that 7 and put 8 there, put 8 years, because I've learned through the years that lots of times after I box up my taxes, I've got it all done, sent the returns in, paid up, everybody's happy, then here comes something floating in the mail that related to last year's taxes. And they'll end up being 4 or 5 of those type things, and I'm not going to go unbox all that stuff and go back to my storage building to stick 2 or 3 papers in, but I normally would just stick them right in the top of the box of this year's returns. So in every year, I'll have some of the following year's information in there. So for me, I use the 8-year term, and I save records for 8 years. Also, when you're ready to make room for the new stuff and you're going to throw away those records that are 8 years old, make sure you just don't take the boxes and have someone toss them in the garbage. No, or put them out in the dumpster. You should open up those boxes and kind of look through them and make sure there's no records inside of there that should have been put in the permanent records. And we do that often now. We'll put something in the 1-year records because we think we might need it in a month or two, when it really should go into permanent records. So just don't throw that stuff away before you check through it. Could be throwing away something that's important. Well, it seems like maybe we have survived another hurricane season. We had a late one come through a couple of weeks ago that, as far as North Carolina, didn't hurt us too bad. But it reminds us that FEMA like they're helping the people down in Florida now, FEMA will come in after a disaster and help small businesses recover after major disasters. Here's what you want to remember. When FEMA asked you to prove how much money you made or what you were spending money on or this or that, you're going to need to come up with the records to show them what you've been doing in the past for them to have a gauge about how much compensation you may be due now. Okay? It's important that you do that. And it reminds me that to say that those of us that are doing our books and trying to avoid as many taxes as we can, if you've got tax returns that were showing that you were not making any money the last 3 years, and FEMA comes to help you recover lost profits, then they're going to look at your books, and if you weren't making any money, they're going to say, sorry, Charlie. Sorry, Charlie. You weren't making any profits then, so what do you have to convince us that you're making profits now? So oftentimes it's important that you do show that profit, even though maybe you're in a situation to do some different things that you don't, but to in case that FEMA comes along that you have that. Okay? Now, this would also be a situation that maybe you weren't making any money, but maybe your business was wiped out and you lost a lot of assets. You lost your tools, you lost your truck, you lost your parts bins, you lost your stock. Well, where will you prove to them that you had all that? On those depreciation sheets. So they can become important again if they're helping you recover lost material and stuff like that. Keep that in mind if you would. Expenses and deductions. Kind of things that come up all the time. We talked about depreciation earlier. Now we're going to get right into the meat of it. So 2 basic things that you want to remember. When we're doing our deductions and talking about our business expenses, we're going to refer to business expenses, regular, everyday business expenses, 100% write-offs, 100% deductible, operating expenses they're called sometimes. A lot of people call them different things. But that's one group of numbers, and then there's another group of numbers that we talked about earlier. Those are the items that are the capital expenses, things that we bought that we capitalized, things that we bought that we are now depreciating, items that we bought that are tangible, items that we bought that will help us save money on our taxes each year. Capital expenses versus business expenses. And you and your bookkeeper, but mainly you, every year as you're buying items, will have to decide pretty much when you buy them in which column it's going to go into. Either a business or a capital. The good news is, as you're buying them, you need to determine what column you're going to put them into. But at the end of the year, when you're getting ready to finalize your books, you and your bookkeeper, or you and your accountant can move items from one point to another and actually see how it affects your taxes before you file your return. It's not I don't put it in February because that's when I bought it, and I'll have to live with that decision in December, even if that decision is hurting my tax exposure. No. You can put it in, the good thing about bookkeeping is they make erasers, and you can delete, and you can plug numbers back in. Business expenses. Those are the items that we don't spend everyday money in conducting our business. It's going to be paying our employees or travel expense for business, or the rent that we pay, the light bill, the water bill, insurance payments. Those kind of expenses are business expenses. They are 100% deductible from your exposed the taxable income. Capital expenses, on the other hand, are those that we've spent a lot of time talking about. They're the larger ones. They're larger purchases. They last for a long time, almost always for a year or more. They are deductible business expenses, but they're called capital because we're deducting them, but we're also going to depreciate them. There's some other terms that creep into the conversation, like depreciation, amortization, depletion. Your bookkeeper and your accountant has a long list of more adjectives to use or actions that we would take related to capital expenses. And right now we don't need to get into those, but I want you to know that as you stay in business for a longer time, you may have to ask some questions about those. That's kind of like, yeah, I'm going to buy something for $10,000, and I know that that's going to be a depreciable item, but I don't borrow money on it for 6 years, and I don't pay another $6,000 in interest fees, interest costs. Well, the rest of the story is those interest costs also can be depreciated. And that's called your amortization charts and figuring out how it comes down in value. And it gets quite complicated, and people have special computers to figure all that out. So that's why I'm not spending a lot of time here in a 1-hour presentation. But there are more to this than just saying depreciation. So let's give some examples now. I want to buy a $250 printer, just like the one I've got right over here. I've got a $250 printer. And with my small business, that printer will last about 10 years, and I'm going to capitalize it. I'm going to put it on my depreciation sheet. And the minute I do, my company just became worth $250 more on book value right then. And it's kind of important that I show that I've got some assets, because if I go to the bank to borrow money, or some vendor looks at me and wants a financial statement, I want them to see that I'm worth more than just my headphones I've got here. So, yeah, I'm going to put that in as a small business. But an insurance company that's got agents out all over the world, you know, there's insurance companies got 250 agents down in Florida right now, appraisers, and each one of them's got a $250 printer that they probably use one a year. Go through them one a year. So that insurance company might have 1,000 $250 printers, and they would not put it in as a depreciable item. They would want to write that off as they buy them. They want to write that off. So one company might say, I'm going to write it off. The next company might say, I'm going to capitalize it and start taking appreciation on it. You've got that freedom, and that's a good freedom to have, because every company is different. When I buy a $2,500 printer, a big commercial one, I would definitely call it a depreciable item. Probably most anybody else would as well. But the cases of paper that I buy for it, $250, I can't write that off as that will not be depreciated. It'll be 100% write-off right now, okay? Because the paper will be used up. If I buy a $2,000 set of tires for my truck, on my truck, I would depreciate it because it will last a long time. But a trucking company would not do that. They would write it off as a general operating expense. If I buy a new engine, I'd write it off because I'm a small operator. That engine, you know, I won't buy but one of those every 15, 20 years. I'd write it off. We're a large trucking company or bus company, probably not. Rent, anytime you rent, that is not tangible. Therefore, that answers the question. It would not be a capital expense. It'd be a deductible. Payroll, always a deductible. The money we pay our CPA, the money we pay the bookkeeper, money we pay the plumber, well, that's just money out. That's expense, operating expenses. But let's talk about a $4,000 set of shop tools. Now, if I went to the shop tool place and bought all those at one time, and they're going to last forever, there's no doubt that I would depreciate those, put them right into my books as a depreciated item. But lots of times we don't buy those tools like that all at one time. We'll buy $50 this month and $100 next month and $500 the next month. Well, the good news is I like to say that through the years, I'd go back and group all those tool purchases. I'd itemize them, come up with a total figure, and at the end of the year, remember you can make adjustments at the end of the year, I'd say, okay, all these added up to $4,000. I'd put them in and start depreciating that expense that you did that, and just put a footnote back on, you know, when you made the actual purchases. That's really important with some items in some types of businesses that you'll want to remember. renting a forklift. I rented a forklift for 24 months for $1,000 a month. Rented on a rent-to-month plan. Well, how about that? Is that monthly rental deductible? It's deductible, but it's not depreciable. The delivery fees, when something's delivered to you, is that deductible as a operating expense? Yes. But is it depreciable? No, because delivery fees are not tangible. But after renting that forklift for 24 months, and I'd paid $24,000 towards that forklift, my rent-to-own plan said I have the option to buy it for $5,000. Well, I want to do that, so I go ahead and write the check for $5,000. That $5,000 check is a tangible item. I am purchasing the forklift there, and I will be able to enter that as a depreciation item. But the rest of the story is the forklift will be going on my books for $5,000, even though it's probably worth $24,000. But the actual purchase price on paper was $5,000, so that's why it goes on the books there. Hence, that's another example why you never want to mix up your fair market value with your book value, because things like that happen all the time. So let's talk about doing some taxes now. Okay, we're not far from that season. I mean, it's almost time to start getting our box down of receipts and start separating them out and seeing where we're headed. And so that as soon as we can get them to our person that helps us with our taxes on January the 1st, we'll be ready to do that, right? So let's talk about it. Not a fun subject, I know. What I want to say to you as new entrepreneurs, I want to encourage you to hire an experienced bookkeeper. If you can find someone that has some experience in your type of business, that is better than you trying to train someone to be a bookkeeper at the same time you're trying to tell them what makes your business tick. So if you can find someone that has experience in your type of business, they will already have a learning curve that you can benefit from. I'm sure they're all good guys and ladies, but that experience can go a long, long way. And you're the same way with your CPA. They are generally experienced because they have to train under before they can become a CPA, they have to have a number of years of training plus a lot of education. But that still doesn't mean they know anything about your business. So what am I saying? You might walk around and talk with someone, Andrea, about who's your CPA, someone that's in the same business you are. And if they can give you a recommendation of someone that they think is doing a good job for them at a reasonable fee, plus they know a little bit about your business, that's always a better thing to do. What's really a bad thing to do is to hire a brand new bookkeeper and a brand new CPA, neither one of them with zero experience on anything. Then you got the blind leading the blind. You're still in a learning curve, they're in a learning curve, and the CPA is in a learning curve. So try to avoid that if you can, okay? At the IRS, they've got some good tips about when you're searching for your bookkeeper and your CPA, things to look for, and I'll give you that link right there in your handout. Two words come into play: avoidance and evasion. And they're very important, and we need to spend a little bit of time talking about that. Tax avoidance and evasion. What's the difference in the two? Well, essentially the difference is avoidance and evasion. The difference in them is which one's legal and which one's not. Tax avoidance is legally exploiting the tax system to reduce your tax liability. And sometimes that involves artificial transactions that are contrived to produce a tax advantage. That's not to say that you broke the law, but just instead of buying something in a cash plan, you decided to buy it as a lease for tax advantages. Or you decided to buy it as a lease purchase for maybe some other types of tax advantage. Or possibly you decided not to pay for it all this year, but to make a deposit, so you could pay for the rest of it next year because of different types of depreciation advantages. A lot of things come into play, and these decisions that you have to make help you avoid paying so much tax. The more you can avoid paying tax, the more money you're going to keep up with to keep your business alive. And as long as you're doing it legally, it is important that you learn to avoid paying all the taxes you can, because they are basically set up to collect all they can, and the ones who know how to avoid paying those are the ones that come out with more money in their pocket, and their businesses get to last a lot longer. So I'm not saying that the tax people are bad or the tax law rules are low, but they cover everybody with the same blanket. That's why you have to know your particular situations and your possible deductions and your possible business trends to help you survive under that blanket. Tax evasion is, on the other hand, is when you actually evade payments, or you hide assets, or for some reason or another you actually lie and cheat about it. And when that happens, that's called tax evasion, and it is against the laws, and they're very good at prosecuting. And there's fines and penalties, and sometimes you go to jail. So we want to stay away from tax evasion all that we possibly can, of course. Now, the hot buttons that we're going to consider, let's talk about those when we're getting ready to do our taxes. The ones that always come up first and last the longest time are the ones listed here. About your home office deductions. Y'all won't be able to take a home office deduction? I can tell you that most of us, that will be a consideration. Travel and meals, the use of your car, always a consideration. You're going to be able to deduct, without much explanation, interest payments and taxes and insurance payments and business and related education costs and uniform costs. But back to the home deduction, that will require a little bit of conversation. In theory, you can take your home office, look at what percentage of your home space is being used up as an office. For example, if you have a 1,000 square foot apartment and you're using 100 square foot of it as your office, that would be 10%. And if it's 10%, then you would be able to add up your household expenses related to keeping that property alive: electricity, sewer, water, painting, grounds maintenance, keeping a roof on it, rent. You'd add up all those expenses, and 10% of it you could put over in the deduction column as a office expense deduction. 10%. 10% of the total spent, because you had 10% of the space as your office. But sometimes if you have to explain that to an auditor, they might say, well, did you really use 100 square feet, or you just sit at your one table there at 10 square feet? Or was this an area that had been roped off, or you had a wall up just for you to conduct business in? It was a little office, actually. Or was it open space in your den? So you can see that could get really, really complicated. They might say, do you have a different door for your customers to come in? Do you really have a home office? Or are you just working out of your home? These questions get hard to answer sometimes. But just do the best you can with it. You're allowed to get a deduction, and you work it out. A tip I'll give you that has worked for me and for a lot of other people is a long, long time. If you can have an outside building or a detached room, or a room that's separated, is really not a part of your house, that you can call and label your office, take a picture of it and show it. You got a door there that says office on it, or an outside building. Then if you can separate that out, then you are able to do this. That space, that building, belongs to you, and you as an individual can rent it to your company, like you renting it to your company. So then each month your company just pays you a rental fee, just as if they were renting a property from someone else. That keeps everything clean, and you can make that rental fee whatever you want it to be. You can make it as high or as low as you want it to be. You need to stay within some kind of reasonable amount, but it can include all the expenses. It can include all the roof repair and lawn maintenance for the whole property, but you have to have it in writing how much per month you're paying. And in that writing, then you would say that you, the renter here, will take care of all other lawn care, water bills, electric bills, things like that, so that indeed that gives you some gray area to pay all the expensive of your household expenses that can make sense with company money. So be careful with that. Make sure you can document some of it. But that sure beats having to figure out the square footage. And in that rental payment that you decide, maybe you can cover all your bases in that. I've been able to, for a number of years, I rent my office building to my company for $625 a month. I've been doing that for 20 years, I guess. And so far it's worked out very nicely. Very simple, easy to keep up with. Now, the money that you take in from your company as rental will be taxable on your personal return. However, the money that the company pays to you is a business deduction, 100%. So it's a kind of a wash there. Good way, though, to make sure you get the deductions that you need. Travel used to be really a really good perk for business owners. It still is. You'll learn how to make that work for you. But used to, you could just basically carte blanche all different types of travel and trips and vacations and things like that. Not the case anymore. Not the case for a long time. You don't have to document the customer you're seeing, what kind of business you were conducting. Is the money you were spending actual conducting business, or was it a lot of entertainment? And if the entertainment gets too heavy, they're not going to allow you to deduct it. So you got to keep these numbers in range, and you need to keep a log and document what you're talking about. Now, my wife and I plan to go over to the mountains this weekend on a trip that we have planned for a number of months. And we're going over there to see two of my brand new customers that have spent a lot of money with me this year, and I want to go say hello to them. Maybe give them a country ham or take them out to dinner or something. And that trip is as legal as it can be for me to deduct the mileage and our stay-in and such as that. But I'm probably not going to be able to deduct my wife's portion or my wife's meals. But I'll be able to cover mine and the gas and the hotel bills. I'll be able to cover the gift that I give to my customers. But a lot of things I will not. So I'll keep a log of what we're doing, how many miles we travel, and all that kind of stuff. So just get some advice from a accountant before you start planning on too many deductions for travel. Now, the use of your car is a big deal. Everybody has to transport, and us as entrepreneurs, maybe we're not ready to buy a fleet of trucks like I used to have with my equipment company. I had 15 plus vehicles for a lot of years, and with that many vehicles, I wanted the company to own those vehicles because I could get a whole lot better rate on service and on insurance, and keep up with them a lot better on my accounting and such as that. But now I just have 2 or 3 vehicles, and it's better now for me to own those vehicles and to charge my company when I use them for company business. So I think the law is this year, I think it just changed, it's 54.5 cents per mile. 54.5 cents per mile, I think is the amount. If not, it's close to that. That you would charge your business for the use of your vehicle, which means that if I drive 100 miles, then the company owes me $54.50 reimbursement. But if I drive 100 miles and fill up the car with $30 worth of gas, that doesn't mean that the company owes me $54 plus $30. No, you're paying for the mileage and not for the upkeep or the maintenance or the parts. or the cost of the vehicle. Got to keep that in mind. If you own the vehicle, you charge the company for the mileage, and you keep up with that mileage in a lot. Okay? Now, if you're having to buy a really expensive or special type of vehicle, I'm going to say that there's a possibility it might be better for the company to own it because circumstances can become kind of complicated. But generally, a nice pickup truck or a nice car, you can pay for it. You can make a payment with it, with the reimbursement that you get from your company if you're driving a lot. If you're not going to be driving it much, you're not going to be getting much reimbursement. So then you'll have to justify how much investment you want to make on this vehicle. I'll also say that sometimes if you're driving a lot and you're gone a lot, you're putting just a lot of miles on your vehicle, sometimes it's better to have two vehicles in your name. That way you can own it and charge all the mileage off of one vehicle to the company while you got the other one there to claim as your personal run around town vehicle that you do your personal business on. So sometimes that's a consideration. Just give it some thought. If you are having over 4 or 5 vehicles, insurance reasons may force you to get it under company name. Another factor, depending on what your work is and how often you're carrying customers or other employees with you, like if you're ferrying employees from job to job, you want to talk to your insurance agent because they may tell you that you'll be smarter and get a better insurance rate to have this in the company name, to borrow the money or to purchase the equipment of the vehicle in the company name and get your insurance that way as well because of liability issues and maybe other people driving the vehicle. Interest. Pretty much easy to figure that out when you're paying interest on items. But I will mention now, take a minute to talk about insurance. As I was coming along as a young man getting started in business with 3 children at home and more on the way, by golly, it became real heavy on my mind that I needed to have some insurance coverage on my life, that if I kicked the bucket, I'd offer some security to my wife and children. And that was on my mind as a young man, and therefore my father gave me good advice on that. So I had all through the years and still do a pretty good insurance portfolio. But when I was younger, I had a larger one to help cover security for my kids and family. And after I became owner of my company, my dad passed away, and I started getting into more debt, growing my business and growing my debt. I needed more insurance so that if I'd pass away, that my debts would be paid. So I had a lot of insurance, and I learned during that process of time that if your company can pay the insurance premiums on your life, your company can pay the insurance premiums on your life as a 100% write-off, provided those benefits, those life benefits, are paid to the company. Well, if you're the sole owner of your company and they're paid to them, paying the company is the same thing as paying you when you're dead, because your estate's going to own that company and it'll be able to pass that money right on to you. But also, and it's still the case, I understand, with a lot of different policies, you can have 49% of those beneficiaries, life beneficiaries, go to other people. And the company can still pay 100% of the policy, provided it's at least 51% of the death benefits. Now that's a big deal, because not only can you provide security for your company, but also for your family, and pay those premiums with pre-tax dollars for yourself. Another issue is that if they are whole life type policies that are creating a cash value, and you keep those policies alive for a lot of years, that at some point in time you may say, as owner of your company and owner of those policies, that you want to transfer the ownership of those policies to someone else. And by transferring the ownership of those policies to someone else, you are transferring the entire tax value of the policy. Now, laws change and all this may not still be in place, but I can tell you that it's something that is well worth you checking out with your insurance person to see how you might set up an insurance portfolio, paying for the most of it that you can with company paid money, and you retaining the ownership and the authority to transfer that policy to someone else at any time in the future. And when that transfer is made, the tax value, the cash values go right along with it. So keep that in mind. It might be something to look into. A lot of ands, if, and buts in different states and different years, and things change. Like this was better than 35 years ago for me, but I still think that a lot of it may be in play. Really good way to set up a savings account for you and for your children, and to put aside some education money down the road. Uniforms and clothes. Owning a tractor dealership and lawn maintenance firm and commercial cleaning businesses, I always had employees, hundreds of employees all through the years. There's always uniform expenses involved, where I was paying for the cost of uniform rentals and purchases for my employees. And then after a few years, it dawned on me that my sales team and my office staff, well, they were having to buy uniforms too to come in. They had their clothes that they wore to work and tore up and wore out. So then I started supplementing them clothing and uniform expenses, and was able to write those off as well, and still do. So I suggest to you that you buy clothes that you would normally use for work 1 or 2 times a year. Excuse me, got hiccups. 1 or 2 times a year. Pay for them with a company check. Save that receipt. Make sure you can document that all these are the type of clothes that you use in your business, and maybe you can get a good deduction right there that you call uniform repairs. Just keep it reasonable, keep it explainable, and you should be all right with that deduction. Now let's talk about the tax preparers and the people that are collecting your taxes. We're right at that time of year, as I said, that you're going to collect all your bills, put them in a big brown bag, and carry them to your bookkeeper, to your tax preparer, and say, here they are. Well, every time you do that, every piece of paper that you hand them, this one and that one and this one, well, accountants account, and they will mark down each piece of paper that you've given to them, and there will be a dollar value associated with them handling that piece of paper. It'll have a number and a dollar value beside it at the end of the day. So anytime that you can do some summarizing, all your gasoline bills, all of your tool charges, all of your this charge, all of your that charge, all of your different things that you can itemize and summarize to cut down on the number of documents you handle to your tax preparation person, you're going to save money. Plus, you're going to become more familiar with where your money's gone, and you'll have a good idea for what's happening. You have a good idea when you compare that with what the bookkeeper's been telling you as well. So then when you hand that summarized sheet of paper to the accountant, they will, if they need more, they'll ask you for it, and you can dig it out of your records. But to save money, summarize all that you can before you give it to the tax prep people, and that'll save you some big bucks for the years. We give money to government agencies as permits and license or estimates and different types of fees. But just to simplify things, let's just call it taxes. If your money goes to the government, it's a tax of some type. And there's 4 different people that take money from us. The city officials, usually at town hall, the town clerk, the county tax collectors. At North Carolina, it's called the NCDOR, Department of Revenue, and the U.S. government, which calls themselves the IRS, and when you pay money to them, it's the U.S. Treasury. So these are the 4 folks in our wonderful, thank God we're here, government, that fund the government by collecting taxes from folks like you and I, and they have to do it, and we have to have a government, so let's just accept it and move on. I'm really happy to say, though, a good thing, in that usually your county folks are fine, your city folks are fine. The federal boys, girls are hard to communicate with, kind of hard to pin down, hard to find a human being on the phone to talk to. But North Carolina state government, not that way. You'll generally find yourself talking with nice folks who are doing all they can do to help you as an entrepreneur. So don't be afraid to call them. But I got to give you a footnote. If you've got an accountant on board and you're using them all the time, let that accountant make the phone calls for you. Yeah, anytime that you can avoid creating a flag with your name on it with some taxing agency, I think is a smart thing to do. So if you've got someone else that can call and ask questions without ever using your name, that's a good investment to make. And maybe you'll get back more information that you can better understand, or maybe change some things that you're doing in time to avoid some problems. So that's one way to avoid problems sometime. Let's talk about these different folks. The main taxes that you will deal with in business are sales tax and use tax. That is, when you sell an item, you have to collect a percentage of tax. And that percentage of tax across North Carolina averages 7%. Notice I said averages, because in one county it might be 8.75%. In another county it might be 6%. But across the state, the average is 7%. In my home county here in Harnett County, it's 7%. But if I had a business that was in Harnett County, I'd charge 7%. But if I had the same business in another county, I might have to charge someone more than that. If I had a salesman that went to another county and actually made the sale, I'd have to charge the sales tax in that county. Sometimes. So all this can get to be quite complicated. If you've got people traveling in this state and other states, how much sales tax do you charge? That's why it's really good to be able to talk to the North Carolina Department of Revenue sales tax people for small business, and they got some folks that'll walk you right through it, or to have a CPA that can do that for you. You can call the North Carolina people and it don't cost you a penny. But if you are hiring your CPA, they're going to charge you for the time they spend on the phone and information they share. That's a decision to make. But if you're just getting started and you don't have anything to worry about, call them yourself. And I've given you the numbers and the location. The good thing about this is in North Carolina, they have regional offices in most of the big towns around all over the state. So you could actually make an appointment and go sit down and talk with someone, or at least you could before COVID. I think they're making personal appointments now, but you could do that. I also mentioned that the North Carolina Department of Revenue has regular webinars and seminars they offer online, and the small business centers sponsor some of those for you as well. But you can check the NCDOR small business, then look for webinars and seminars, and they have some good training classes online as well. Different types of taxes. Sales and use tax we just talked about. You got withholding, that's related to your employees and your employment taxes. Privilege license, which is what the local counties would charge you and local towns for the privilege of doing business in the entity. They're usually very low expensive and not a big deal. Unemployment insurance, that is to say every time that you have an employee that you give them a paycheck, a payroll check, that means you got to write another check to the state to cover their unemployment insurance, plus whatever other deductions they might have. Okay, you didn't know you were going to be a Hardee's or a McDonald's, but you're still going to pay a franchise tax. The franchise tax doesn't have anything to do with the type of business you have. It's just a name that the federal and state governments have put on the tax return for a tax that you're going to pay whether you make 1 penny or not. Yep, it has nothing to do with your income or your profit and loss, but just because you're in business, they're going to always get a little bit of money from you, and it's that right at the tail end of your tax returns on the state and federal. It's called a franchise tax. I think it's $100 for the state, maybe $200 for the feds or something like that, that you'll pay every time you file your taxes. Whether or not you owe any other taxes or not, even you might be getting back a return, but you still don't pay those franchise taxes. So just know it's coming, usually very low amount. Your county taxes kind of are a whole different bugaboo, and in some businesses it don't make hardly any difference at all, but in others it can make a really big difference because they're going to tax you on your business property, vehicles, inventory, not sellable inventory, but just regular stock, rental and lease equipment that you own, and other items. Pretty much everything that the county will charge you tax on is on your depreciation sheet. So we started this program talking about the depreciation sheet, right? Well, we're getting right back to it now because that is the basis for your county taxes. So as a business, when it's time, the first year you're in business, you will need to file a county tax return. I'll tell you that tax return is due in. It's due in before February 1st each year. Generally, they mail them out in January, and you're supposed to send them back in before February 1st. If you do not file your taxes before February 1st as a business, then you're going to have a 10% penalty. That's right, a 10% penalty when you do file your taxes. If you ask for an extension, then they will gladly grant it to you, and you will not have to pay that penalty. So how do you go about asking for an extension? You go to your website for your county, the tax department, business returns, request an extension. They've got right down on your menu list. Every county has this, and they will send you an extension, and you won't have to pay the penalty. You will have to file by April 15th, or they're real close to it. Why would you want to get an extension? Well, if an accountant is doing your work, they're not going to have there's no way that they're going to have your tax return ready by February 1st, or almost never as a business, and they're going to be waiting around to April 15th or May 15th to give you your return. So as a business, you can almost never file your county return because you're waiting for the accountant to give you that depreciation sheet. So that's why. So just make a footnote on that, something you'll want to do. As you're filling out the county depreciation sheet, or the county, what you're listed as your assets, and you're writing those down, you'll take the value. Here's a neat thing. You'll pay taxes on the book value. That's cool, right? Not on the fair market value. So the counties give you a break there. They could, if they wanted to, easily change the rules to make you pay taxes on the fair market value of your depreciable items instead of the book value, but they don't. You pay taxes on the book value, so that's a good thing. But as you're listing those down, all the little computers or refrigerators or shop tools or vehicles or trailers, you want to make a mental note. Now, if I had to go show this to the county inspector that comes by, would I be able to show him each of these items? Because someday he may walk in there and say, I want you to show me these assets that you're paying taxes on, and then I want you to tell me about these other things I'm looking at. That's how they do their audits. Show me what you pay taxes on, but tell me about the rest of all this stuff, and why didn't you pay taxes on that? So there you go. If you ever get that auditor come in, that's the thing. So if you've got that other stuff there, and we're going to do all the way back around the circle, and it's still on your depreciation list at salvage value, like $10 or $100 or $2, if it's still on the depreciation list, then that's going to make that argument a whole lot less. But if it's sitting out there and has a high value and it's not on that depreciation list, the county inspector is going to say, why? And you might have to have some questions and answers going on then. Okay? Let's talk about the auditor. Kind of a bad word in the business world, auditor, no doubt about it. I agree with that. And I don't want to be on the auditor's radar screen, do you? Well, the good news is less than 1% of all tax returns are going to be audited, but there's a good chance it would be me or you, because we could certainly be that 1%, and especially now that the government's decided to beef up the IRS. But what's going to keep our name off of that list of the auditors is how many red flags are we sending up? We send up red flags with our tax returns. Yep. It goes into the system, it's opened up, and it's fed through a computer. And the computer reads the lines and compares these lines to other people in our type of business. It compares the lines that we fill out to what we did last year or during the last 10 years. I mean, they've got some smart computers, right, that run all different things. And if the computer senses that something is kind of out of balance or different, a red flag comes up. You get a ding, ding, ding. It goes over into another file. Somebody's going to take a special look at it. Well, that special look is where audits start. So what can we do to keep our red flags from flying up off of our returns? I'm going to give you a list, a real short list, but a big important list. One is do business with tax preparers that are reputable, that you trust, that have been around, and not somebody that has just moved into your neighborhood and put up a flag or a sign out in the middle of his yard or at the street corner saying, let us file your taxes and you'll get a $3,500 refund. Refunds guaranteed. When you see those, you're dealing with scammers, and you've got to be careful, because they will fill out that tax return so that maybe you'll get a refund back, but they're going to get that refund or a good chunk of it, and you're going to get some money, but also you stand a good chance of that flag going up and the government coming after you, not only for the refund, but also for a penalty and a lot of interest. So if you don't know someone to be good and honest and trustworthy, don't let people do your taxes that you just can't trust. You know, we hear every year we'll see on TV, especially this time of year, late at night, oh man, I want you to call Ultima Tax Refund. These people helped me out. I owed $25,000 and they helped me. Or I was in big trouble with the IRS and these people came along and bailed me out. And we hear these stories every night, don't you? And you'll hear more of them this time of year when it's tax filing term. I'd bet money, and I'm just guessing now, that more and more of those are the people who were dealing with the people who did the shady returns. These people owe the IRS big bucks, maybe because they either didn't file their returns or they filed them with someone that was trying to get a lot of refunds back that maybe they didn't deserve. That will come back to haunt you. It really will. So be real careful with them. Unreported income. Well, probably nobody in the whole world's going to report every single dime that they take in, every piece of commission or gifts that someone gives you or a little bonus. But let me tell you, if you start hedging big time on reporting your income, it will come to haunt you, because they know how much a beautician takes in a week. They know how much mechanics make. They got a good idea, and they have folks that ride around and sit outside in your neighborhood and count the customers going in and out of your house. So be careful, report your income, pay your taxes. The good news is, as entrepreneurs just first getting started, if you've kept up with your expenses and your deductions, there's a good chance your tax bill is going to be so low it will be incredible. And if you do have the privilege, honor, and good fortune to have had a great year and made a lot of profit, then I gave you warning, you should pigeonhole that money, right? Pay those taxes and be happy. Look forward maybe to a refund coming back. But be real careful not to fudge on reporting the income that you're supposed to report. Not filing on time is a problem that will raise a flag if you do it year after year after year after year as an individual, and there doesn't seem to be any apparent reason. Now, I gave you a reason why you can't file your county taxes on time, and that's accepted by the county authorities. And similar situations with the feds. But if you just seem to be fudging because you just don't have the money or you're not ready to pay it, that's a problem. You can file an extension to pay at a later date. But you need to know, just because you don't have the money now to pay the taxes, don't mean you're going to get a break. Because when you do pay those taxes, they're going to charge you interest from April 15th to the point that you did pay them. The good thing is that if you got an extension, you're not going to have to pay a penalty. If you didn't get an extension, you don't have to pay a penalty. Okay? So that's why you would do that. Wrapping it up and putting a circle around it now. What are the business priorities that you have? Before we leave tonight, we've been talking about taxes and depreciation, but now let's get back to what we need to think about every day, all the time. In selling your products, are you offering take it or leave it, or are you giving your customers some room to negotiate? During the course of this series, I'm going to encourage you to find ways to help them find rooms to negotiate. I want you to create raving fan customers, customers that will do business with you and keep sending business your way. We'll talk about that next week. You're going to need a database. That is a list of customers that you can keep sending out constant promotions, because we can't be all things to all people. We must be everything to some people, and those some people we need to stay in touch with so they will become our raving fan customers. On the internet, 2 important pages. Our mobile page is critical. So I'm going to ask you, what does your mobile page look like for your company? Because 85% of the people shopping are doing it on their phone now, and the first thing they see is your mobile page. Do you have a Google My Business account or a Google profile account? If you're up and running and you got your business running, that's a real important factor for you. I want you to figure out how to get it and get it in a hurry. So I hope to see you all next Tuesday night, where we're going to talk about 20 businesses that you can start with $100 or less. And we're also going to talk about how to create raving fan customers with the very best customer service. And I think that the very best customer service is that it starts with a capital S. I'll give you some really good points on how to help keep your customers by doing that. I want to tell you all that I appreciate you being with us tonight, and I look forward to hearing from you and seeing you back. Send me emails anytime that you're ready, and we'll answer any questions we can. I invite you to turn your cameras on now if you'd like, and we'll discuss any things that you have to say or hear from you. I see we have some new people come on. Rhonda, glad to have you, and Andrea come on board with us, and Sarita. Good to have you coming on board with us as well. So good night, everybody. I'm going to turn the share off, and we'll chit-chat before we go home.
I have a question. This is Tisha.
Hey, Tisha, how are you?
Good. Like, I've had my business in the past now, and since I'm like starting it back up again, do I start all over again with the depreciation stuff, because I'm basically still using my same machines? So do I re-put them in under the whole depreciation thing, or do I just don't put them in at all?
Were you filing taxes as a business?
Yes.
And how long ago was that?
Oh, Lord, it's been a while back, but it was in another state.
Okay. Do you still use that same business name and EIN number?
Yes.
All right. And each year, have you filed a tax with under that number?
Okay. In the state that I was in, when I called them, they said that for the years that since I hadn't done any business, I still would have to file, but it was some other form I had to fill out showing that I didn't make any money or anything.
Right.
Because I had just started working a regular job.
Yes. Uh, that's a tough
But I know
question to
North
answer.
Carolina is a little, yeah, North Carolina is a little different from California.
Yeah. I would suggest that you on this one. I'd suggest that you talk to a CPA. I don't know the answer to that.
Oh, okay.
One thing you'll find out about Steve, I'm not no. I'll give you the answers I know, but those I don't, I'll say let's find somebody that knows a better way. My gut feeling is that if you've been continually filing forms, I just keep right on filing, just update them as I go. Uh, but that'd be the most simple way for you to do it. And if you're going to use the same equipment and such as that, that would be easy for you as well.
Okay.
Okay, well, good. Well, thank you for calling. I'm looking forward to watching your business grow.
Yep, me too. Thank you.
All righty. Okay, who else wants to talk to me? Andrea, you want to turn your mic on? I'm glad to see you on board. I was going to ask you where you're located.
I'm here in Cary, in the Cary area.
All right. Well, thank you for joining us. What type of business are you into?
I'm a realtor. I'm a broker. I own my own company, Andrea McLeese Thomas Realty.
Well, good for you. Well, I hope you enjoyed the presentation tonight and will join us in the future.
I will. I did have one question because I work out of my home, and I have a home office that I do the square footage with my taxes, but it's inside of the home and it's not a detached office. Would I still be able to claim rent?
Do you have an outside building?
No, I don't.
No garage, no detached building at all?
None.
Because your outside building or attached garage don't really have to look very nice or be a pretty office. So your question is, but if you've got a dedicated office part of your building, of your home, is this dedicated to the point that you've got a customer entrance and a bathroom for them?
I do.
Well, you're covering a lot of bases. I'd give that some serious thought. Document that you have it. It's not detached, but it is absolutely independent. And talk to your CPA about that.
Thank you so much.
Yeah, because if that's the case, you could charge as much rent as you wanted to, and but you want to, as a real estate person, they're going to be looking at you extra strong.
Yes, I know.
All right. Well, thanks for sharing. Yes, ma'am.
Thank you.
All right. Anyone else? All right. I do hope y'all have a great week, a great weekend. I'll be covering this same ground tomorrow night and Thursday night, and would love for you to join us again. And I know our sponsors would. But otherwise, I'll see you next Tuesday night, and we'll have a lot of fun. Hey, it's supposed to be cold the next couple of days, so bundle up, and Mr. Winter is showing his face. Y'all take care, and God bless you all.